All right, sharing the stream. All right, we got this set up. All right. So today I hit a 227% gain on SPY right here. Let me show you the screenshot. This was in the matter of maybe like within an hour or so, around 3 p.m. Eastern Standard Time. It's kind of right before the 315 ICT macro, but it's basically power hour that we were shooting for. Now, kind of go over what I saw pre-market that led us to this move all the way up to the top of the range and why I was so bullish for today. So I usually have both NQ and ES up. NQ's on the right, so NASDAQ and S&P 500 on the left. And the reason why they are really good correlating pairs that you can spot out divergences. So if you see one asset weaker than the other, right, there's a signs of that usually shows signs of reversals when you're at key levels. So I do have a lot of stuff here, but we'll try to take it step by step. So on the left hand side here, right, we have ES. If we go to a much bigger time frame, and the way I like to structure things, especially for these moves, is really I'll have a weekly outlook at the beginning of the week, but then I'll look at the 4-hour, and that correlates to your 15-minute for your smaller time frame, and then 1 minute is your entry model. So on 4-hour, what I'm looking for is external range liquidity, and so if I just let's do one at a time. One of the things I have on ES, right, are one of the indicators is this 4-hour, not 4-hour, but the auto daily exponential moving averages, right? So this green jagged line that you see here, that's your daily 9 EMA. And then you have this teal cyan, which is your daily 21 EMA. So you can see up to this point, and this is Monday night at 6 p.m., right? That's when we got this displacement down below, and we have this wick right here. This is the only time that it ever broke down below the 21 EMA. All the previous days, and last week especially, right, we see a lot of down wicks that was breaching this 4-hour ERL. ERL stands for external range liquidity. So if I move all the way to the left, you can see that there's this one wick, which is used as a swing point, that we have a higher low in this case, right? Because we have an uptrend going up here. So this is a target for liquidity. On your bigger time frames, you can see that a lot of people will have stops down here, and throughout last week, Wednesday, Thursday, twice actually, right? We broke below this level, and sellers were not rewarded by having price push lower, right? So anyone with stops below this whole entire area, right, this whole entire area, they all got stopped out. And so that provided liquidity for fuel to move up higher. And where we're looking at is a supply zone up here, which is this red box. That was the target, which it actually hit and rejected and brought us all down below. But up until this point, that external range liquidity I was looking at was this daily 21 EMA. It never broke until Monday, basically right at close. So just remember this point. This is that Asia low. So I have a couple of different things here. We have London, 2 London levels and 2 Asia levels, right? And I have one right here, FOMC high, which was last week on the 18th. Actually, a few weeks ago on the 18th. So those are some key levels I'm looking at. So if we go down to just to analyze this one wick down, right? If I go to a 5-minute chart, and we come back down here, we can see right here the this down candle broke below the daily 21 EMA, but reclaimed it pretty quickly, right? So this is the 5-minute candles. So what does this mean is that we swept all the liquidity to the left, right, with these candles, but then sellers who expected a aggressive move down after putting in this big red candle, they were not rewarded, right? So that means buyers are in control. All liquidity was swept. Another indicator I have that kind of helps me mark out my time-based liquidity and session highs and lows is this 90-minute cycles. Right, what this does is it puts all the candles into different categories where we have 90-minute cycles within larger time frames. So, for example, right, like this session goes from, this is the Asia session that you can kind of see right there, Asia. So this is the beginning of the Asia session, and what I do each morning is I mark out the session highs and lows. So down here I put Asia. It doesn't really matter if I put down Asia high or Asia low. I just want to see the extent of those the candles. So we have Asia low down here and Asia high up here. So I mark those up. And then the next session is London. And so I have London high, which is up here, and then London low, which is down here. You can ignore this demand zone. This demand zone formed overnight, right? We're kind of looking back in time. So now I have these different levels on my chart. I can kind of gauge as to if price were to break below some of these levels or above, right? What is the reaction and where is the draw on liquidity going to? So for example, I mentioned again, if I go turn this 9-minute cycle indicator off, and now I'm going to go to my 4-hour, right? When I was saying, let me get back. We got 4 hours, so that wick that I was showing, which was that Asia low, went below. Sellers were not rewarded. Buyers stepped in. We came back above the daily 21 EMA. So when we had the sweep of liquidity, we need to, and we grabbed all that liquidity. What's the target? The target is the opposing liquidity, right? So the opposing liquidity, there's actually two levels. One is this 4-hour swing point, which is this lower high right here, which is at 57.89. But then we also have the origin of this whole down move. That origin was this rejection of the supply zone. So at the end of the day, the final target really is this top of the wick, and it missed it by just a few points. But if we are now moving down to a smaller time frame, we can see why this move up was pretty much predictable, right? So keep in mind, one, we had the sweep of liquidity down here, and now we want to move to opposing liquidity, which is all the way at the supply zone. So I said 4-hour goes to 15 minutes. What do we have here? We have essentially a market maker buy mile, which is an ICT concept. And so what it really is, it's a few periods of consolidation and accumulation. So we have a period of accumulation right here. So this is one. Second period of accumulation right here. This is two. Broke down the daily 9 EMA. And a third accumulation phase down here with a sweep of liquidity down below. So if I go to an example that I found, let's see, this one, right? The market maker buy model is what I would just describe, right? We need to have at least 2 consolidation accumulation periods, followed by a break of a key level. This doesn't really mention it. This mentions level of the week, but it's okay. But we're looking for a break in liquidity sweep of a key level, followed by a few consolidation zones as well, followed by a final target of a draw on liquidity that's higher than the first accumulation phase. So this intra-week highs per this graphic, right? We want to breach that. So now that we see this market maker buy mile, we'll go back to our chart, and we can see that one accumulation phase, second, and then here's the third with that breach of liquidity, and then we move up higher. So what else are we looking for is our market maker, not market maker, but market structure shifts. So this is 15-minute, right? We want to identify if there are any fair value gaps. So most recent fair value gap, and I actually deleted this already, but if we look here on the 15 minutes, right, we have this large fair value gap. So when we get back into this price range, if we are able to invert this fair value gap, and what this means is that we completely go past the fair value gap extent, and we actually accumulate everything, we are definitely due for a reversal, right? So a couple things is, one, after breaking this bearish fair value gap, right, we created additional fair value gaps, and you can see here on this candle. So originally my prediction is that we would enter back into this fair value gap and then move higher. The thing is, when you have inverted fair value gaps like here, you are less likely to invert or come back into that bullish fair value gap. I think there's a concept for it for like a breaker block, but essentially it's a inverted fair value gap. So it's more likely that you wouldn't really sweep liquidity on this area because of that inversion. So where did I enter? I didn't enter actually until pretty late, because I recognized that this was a market maker buy model, and this liquidity, this inverted fair value gap was established, right? I was actually looking for a retest of a smaller fair value gap. If I go to, I think it was the 5-minute or the 1-minute, right here. Right, we have all this liquidity from that accumulation phase, but at the same time we had this higher low, but we also had a VWAP. So my original thesis was that we would come down to VWAP and then move higher, but it actually didn't get to VWAP. But we did put in a market maker market structure shift, creating another inverted fair value gap on the smaller time frame right here. So we breached that fair value gap, and then because we accumulated in this area after breaching that fair value gap, it was a pretty clear sign that your draw on liquidity was much higher, right? So it would be the higher supply zone, but at the same time we have a very large trend line that we're currently respecting, right? So 1, 2, not here so much, but 3, which was really from today. So that's where you get from sweep of liquidity all the way to opposing liquidity, which is your supply zone. So on the flip side, we had the same exact thing on NQ, right? Same thing down here. We breached the daily 21 EMA. This one was a little bit more not as clean as ES, right? Because on ES we never broke the daily 21, but in NQ we did. So when we breached the daily 21, the thing is, on the daily 21, we're actually also reaching this. I also have weekly EMAs here too. So this daily, weekly 9 EMA and then weekly 21 EMA. I thought we would be able to tap it because we still haven't touched it in quite some time. But the thing is, I had this listed a long time ago, right? That we have lots of SMT. SMT is divergences between the correlated pairs, so NQ and ES. When you see divergence at the bottom, that is a bullish sign, which is a sign of reversal, and then if you see divergences at the top, then that's a bearish sign, right? So down here, for example, right, like right here on ES, we have this low wick, right, which is relative to this wick. This one is higher, so we are making a lower low here. But on this side, we have a lower high, so that's one divergence, right? So as we approach this area, seeing the divergence down below, and we don't sweep these divergences, it's more likely that we are going to reverse. So really, that ES confirmation correlated to what NQ was showing with that displacement down, but quickly back up, sweeping all liquidity, is what really gives you the move for the drive to a higher external range liquidity, right? So if we look at the 4-hour on on NQ, right? Your external range liquidity, you have 2 points also, right? One is up here, which was on Sunday Asia Open, essentially, right? And then we also have this other swing point up here where there's a couple wicks in that area. So we did not breach that, but at least this kind of predicted that once we swept the liquidity down below, we would move up into some other opposing liquidity. And that's all. It was a 227% play, but that's because there was 0 DTE. If you had something like a 1-day expiration, right? I got mine during power hour, so you got that 227%. But if you got 1-day expiration, the thing about options is, if I go into small time frame, right? We have a big impulse. Impulse brings a lot of volatility, which really spikes up the premium. So really this one candle right here, where you can see from 790 on ES to 97.50, so that's 7.5 points. That jumped the contract from like 20% to over 100% from just one candle, because we're in getting close to power hour. So this was actually at 235, right? So I actually took profits along the way. I had 3 contracts, took profits at like 20%, 50%, let the run ride until the external range liquidity, and finally took my last profit right around the 5,800 level. So that's the whole market maker buy model. I'll probably do a fuller recap as to, or a lesson as to what I'm looking for external range liquidity and internal range liquidity, fair value gaps, a lot of these ICT concepts. ICT teaches a ton of stuff. A lot of the concepts are kind of overwhelming, but you don't really need all of those. What you really need is just that simple external range liquidity, internal range liquidity progression with entry models. And then the main thing that I really look for that has really got me consistent is really finding out if I got any kind of sweep of liquidity to feel a move in the direction I'm looking for. If I don't have any sweep of liquidity, just like right here, then there is no reason for the market to move in that direction that I'm really looking for. And this mainly applies to the indexes. I haven't really back tested or tested as much on a lot of the equities, but the whole concept of liquidity grabbing is a very real concept even in equities, regardless if it follows fair value gaps or not. So that's it for tonight. That's it for this trade recap. Hope you all enjoyed it. I'll see you all next time. Peace.